When it comes to global diversification, the US is the number one choice, and there is a good reason for that. The US is home to world's most iconic companies such as Apple, Google, Meta, Tesla, Nvidia, Microsoft, and so on. These companies are leaders in innovation, and their products and services are used across the world. And why just tech? In other sectors too, US companies have a dominant presence and their products and services have got deeply integrated into our daily lives. The returns from the US markets have been quite mouth-watering too, and this has further added to the appeal to US companies. The chart on your screen displays returns from Motilal Oswal's funds which take into account rupee depreciation. But there is something investors often miss. And what's that? Well, most of these returns have come from just 7 stocks. So, if you look at the past 5 years, companies such as Nvidia have delivered over 1000% absolute returns. Even Alphabet and Tesla have delivered over 200% each. Now, the might of these 7 stocks becomes even clearer if you compare the S&P 500 with the S&P 500 equal weight index. Now, if you look at the S&P, it's a free float market cap index. It means a company with higher free float market cap gets a higher weight. For example, Nvidia's current weight is 7.5% in the S&P 500 index. Now, over the past 5 years, the S&P 500 index has delivered about 91% in dollar terms. But the equal weight index, where every stock gets the same weight, returned only around 63%. Now, this gap shows just how much the Magnificent Seven have been driving overall market performance. These stocks have also influenced the valuation of the US stock market. The S&P 500's 10-year rolling price to earnings average is 19.3 and it's currently trading at 27.8 times. So, if you feel the US markets are becoming concentrated or too expensive, then where else can you invest? The answer to this question is important as it can aid diversification and help reduce the risk related to US stocks. And in this video, we will delve into this question. Hello and welcome to ET Money's YouTube channel. If you have an overseas allocation in your portfolio, or if you're planning to invest in overseas equities, this video will prove to be immensely helpful. So do watch it till the end. Now this video belongs to our playlist on alternative investments. If you'd like to watch more such videos, you can explore it. The link is in the description. Okay, now let's talk about the first overseas investment avenue other than the US. Since India is a developing market itself, for an Indian investor, developed markets can be a good source of diversification. Apart from the US, which is a developed market, Indian investors can consider Europe and Asia Pacific. But do know that not all European countries are developed. The developed basket with Europe consists of the UK, Germany, France, Netherlands, Finland, Sweden, Denmark, Italy, Spain, Norway, Belgium, etc. The developing countries in Europe include Poland, the Czech Republic, Hungary, Romania, Bulgaria, Greece, Turkey, etc. The Asia-Pacific region comprises countries of East Asia, South Asia, Southeast Asia, Oceania, and the Pacific Islands. Among these, Japan, Australia, New Zealand, Hong Kong, and Singapore are developed. Alright, let's take a look at the performance of the developed Europe and Asia-Pacific markets now. For developed Europe, let's consider the Stoxx 600 index. It can be considered as the counterpart of the S&P 500 in the US. Now, over the last 1, 3, and 5 years, the index has returned 11%, 16%, and 12% per annum respectively. For the Asia Pacific region, a good indicator is the FTSE developed Asia Pacific All Cap Index. Based on that, over the last 1, 3, and 5 years, Asia Pacific markets have returned about 16%, 19%, and 9% respectively. Now, these returns are surely less than those offered by the US markets, but they are quite decent and given the accompanying benefit of diversification, actually quite welcoming too. But that's region specific. Within Europe and Asia Pacific, different countries have developed quite differently. For instance, consider the major indices within Europe along with their returns. Germany, Italy, and Spain clearly stand out with their 1, 3, and 5 returns being quite handsome. On the other hand, comparatively, the performance of the French and UK stocks has been lukewarm. Alright, now let's take a look at the performance of the key markets within the Asia Pacific region. Now, within this region, Japan's Nikkei 225 and Singapore's FTSE STI have done quite well. Hong Kong's popular Hang Seng Index has performed quite well over the past 1 and 3 years. The performance of Australian and New Zealand markets has been lukewarm. Okay, so if you want to invest in Europe and Asia Pacific, how can you do so? The first option is the international funds available in India. Unfortunately, there aren't many options as of now, as most funds are closed for fresh inflows given the RBI's restrictions. Still, two relevant funds are open for inflows: Edelweiss Europe Dynamic Equity Offshore Fund and HSBC Asia Pacific Dividend Yield Fund. Both the funds have a decent return profile if we check their last 1, 3, and 5-year trailing returns. Now, do know that HSBC Asia Pacific Fund does not invest in Japan. So that's a major limitation, as Japan is a key market in the Asia Pacific region. Asset-wise, both the funds are quite small, with HSBC Asia Pacific Fund's assets being under 100 crores. Now, apart from these two funds, there are two Hang Seng ETFs available on Indian stock exchanges. Now, while investing in ETFs, you must always check the ETF price versus the INAV. If the ETF price is higher than the INAV, it means you're getting the ETF expensive. Now, both these ETFs have shown deviations from their INAVs, so be mindful of that. Now, if you have a US trading account, you can also invest in the US ETFs investing in developed European and Asia Pacific markets. With an AUM of $27.6 billion, the biggest ETF investing in developed European markets is Vanguard FTSE Europe ETF. Two more options to invest in developed Europe are iShares MSCI Eurozone ETF and iShares Core MSCI Europe ETF. For the developed Asia Pacific, Vanguard FTSE Pacific ETF and iShares Core MSCI Pacific ETF are main options. Now, while these ETFs invest in developed European and Asia Pacific markets, they are listed on US stock exchanges, so you can invest in them via US trading account. If you would like to invest in a particular country of developed Europe and Asia Pacific, that's possible too. A number of iShares line of ETFs offered and managed by BlackRock make it possible. Now, apart from ETFs, you can also invest in European and Asia Pacific markets via stocks. But for that, you will need a special overseas account that enables trading in multiple markets and not just the US. However, do know that investing directly in stocks requires far greater due diligence, skills, and commitment of time. So explore the direct route only if it's suitable for you. Finally, let's also see some important things to keep in mind when you invest in developed Europe or Asia Pacific. First, remember that entire Europe or Asia Pacific is not developed. So pick only those funds that invest in developed Europe and Asia Pacific. 2. Developed Europe and Asia Pacific are considered as low growth regions, so adjust your return expectations accordingly. 3. Both these regions are dominated by old economy businesses, so don't expect to find many technology related stocks and their associate bumper returns here. Okay, let's now look at the second alternative to US markets. The other avenue for Indian investors apart from the US and the rest of the developed markets is emerging markets. Emerging markets are economies that are not developed but are on the growth path. They tend to be riskier than developed markets as they can offer negative surprises on the economic and political fronts. Now, the various pockets of emerging markets include Asia, Africa, South America, Eastern European countries, and Mexico within North America. India is also a key emerging market. Now, the returns of some of the emerging market indices other than India are on your screen. The Athens Composite Index of Greece stands out across time frames. South Korea's KOSPI and Mexico's IPC have done well too. China's and Brazil's have a middling performance. Now, to invest in emerging markets, the first option is the international funds route. Quite a few international funds catering to emerging markets are still open for inflows. So that is good news for investors. The two largest funds by AUM in this lot are Axis Greater China Equity FOF and Edelweiss Greater China Equity Offshore Fund. Greater China funds invest in Hong Kong and Taiwan too, apart from mainland China. Now, Edelweiss ASEAN Equity Offshore Fund specializes in investing in ASEAN countries that include Singapore, Indonesia, Malaysia, Thailand, Philippines, Vietnam, and others. HSBC Brazil Fund has a narrower country-specific approach. Now, if you have a US investment account, you can open up even more investment avenues for you. With an AUM of $112 billion and $103 billion respectively, iShares Core MSCI Emerging Markets ETF and Vanguard FTSE Emerging Markets ETFs are the giants in the pack. iShares Latin America 40 ETF specializes in investing in Latin America. A comparatively very small ETF, when Egg Africa Index ETF allows you to invest in African countries. The return profiles of these ETFs are on your screen, so you can take a look. Now, if you're interested in specific countries in emerging markets, there are plenty of options there as well. Performance-wise, South Africa, Mexico, Israel and Poland have stood apart. On the other hand, Indonesia and Saudi Arabia have disappointed. Of course, the third option to invest in emerging markets is to take a direct stock exposure via an overseas trading account that allows trading in multiple countries. However, this option should be best avoided even by enterprising investors as it's highly risky. And it's not just the risk of economic or political conditions, lack of sufficient information and delayed arrival of crucial information are risks too. Hence, emerging markets should best be explored through ETFs and not direct stocks. Also, to consider the fact that India is an emerging market itself. So, as an Indian investor, you are already exposed to an emerging market. Last but not least, don't discount the fact that emerging markets are vulnerable to systemic upheavals. For example, multiple regimes in the Middle East and North Africa were toppled in the aftermath of the Arab Spring. This virtually shattered the economic landscape in the affected countries. Sri Lanka suffered a similar fate in 2022. Thailand has suffered 13 successful and 9 unsuccessful coups in just over a century, with the latest one being in 2014. In December 2024, the South Korean president declared martial law, which jeopardized the country's democratic fabric. Even in China, the government imposed tight capital controls, including a ban on selling shares, to arrest the market crash in 2015. Overall, investing in emerging markets is fraught with high risk and uncertainty, and if you choose to take exposure to them, never go overboard with your allocation. And with this, it's a wrap of this video. I hope you found it useful, and if you did, please share it with your friends and family. I'll be back soon with another video. Till then, take care.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.